Nicholas Bornells of Capital Inc. I'd like to welcome you to the Capital Markets panel of our Shipping Forum. Capital Markets is clearly one of the key components of our forum, especially given that the majority of the companies that participate are publicly listed, and they have been using the capital markets for their growth and development. So we have with us a great group of panelists. I will thank Rob Lustrin of Reed Smith, who is going to be the moderator, and of course the panelists, James Cirenza from DNB Markets, Larry Glassberg from Maxim Group, Chris Weyers from Stifel, and I hope Christa Volpicelli will join us very shortly. Christa has been doing heavy lifting today, being on 3 panels, so I hope she will join us shortly. Thank you to all of you, and Rob, the floor is yours. And thank you to all of you for your support, because we have been supporting this forum throughout the years, and thank you very, very much.
Thank you, Nicholas, and it's a pleasure to be here with all of you today at another outstanding virtual Capital Link event. And I have to thank Nicholas and his team for putting this together, and it's just terrific as usual. So the last time I sat here in this chair was maybe towards the end of last year, mid-October, where we ended our capital market session with a generally positive outlook for capital market shipping deals, even amid, at that time, volatility in the major stock indices. Of course, in this moment, as you've heard nearly all of the panels, both yesterday and today, there's been substantial disruption in the markets, with both positive and negative aspects for shipping, and to a much lesser extent due to the second wave of the Omicron variant sweeping by, with the war in Ukraine being the primary driver of some of this disruption, obviously. And share price volatility is still continuing. So it was stable for a little bit back then, since October, and I think the Ukraine situation has really reinstated a period of volatility among these stock indices. Now, as we've heard throughout yesterday and this morning, the consensus seems to be that there'll be continuing demand growth in both the container and dry bulk sectors, and the expectation of growing ton-mile demand for tankers, with charter rates appearing to stabilize, at least at the moment. So we will focus on the capital markets opportunities for the shipping industry in light of these very recent and very significant events and trends. Let me introduce our panel of Wall Street investment bankers, all of who have truly shown their commitment to our industry and have been active for many, many years, and can shed both their long-term perspective and their observations about what's going on currently in the marketplace. And I'll do this in reverse alphabetical order by last name, just to be fair, since last time I went the other way. So Chris Weyers is with us. Chris is a managing director and the head of Maritime investment banking at Stifel. Christa Volpicelli will be with us, hopefully. She's managing director and head of Maritime investment banking at Citi. And of course, Christa is also the conference co-chair. She moderated a panel just a few short moments ago, I suppose, as well as being a panelist on a number of panels here. So we thank Christa for participating here and hope that she will be able to join us shortly. Larry Glassberg, partner and senior managing director of investment banking at Maxim Group, and Jim Cirenza, who is a managing director at DNB Markets. So we had heard varying degrees of enthusiasm for capital markets activity at the end of 2021 into the beginning of 2022, with really not much actual capital raising activity on the part of shipping companies. We have the Cool Company IPO, which took place on the Oslo Bourse earlier in February. That's been a little bit of a standout and an interesting situation. But as I indicated during my opening remarks, all of the major stock indices have continued to exhibit share price volatility. And, we heard from owners in an earlier panel, but for each of you, our investment bankers, I'd like to hear, and I think our audience would like to know, where are we right now in this moment what's happened so far in 2022, what opportunities exist in the capital markets for shipping companies. And let's start with Jim Cirenza. Maybe you can give us a little bit of an overview. And I think if we can focus on equity, that would be great. But obviously, your overall view of the capital markets today would be appreciated.
Thank you. So if we just take a snapshot, first of all, of where we came out of last year, greatest year in the history of the equity and high yield capital markets ever. Now, it pretty much came to an end around Thanksgiving. But if you look at the equity side, just in the US, $850 billion was raised last year. That's about double the prior record. So phenomenal year. And shipping was an important part of it. The SPAC market had some entrants. The ATM market had plenty of activity. There was an IPO or two. So the shipping was a big part of the capital markets last year. So where are we so far this year? We're just about to finish Q1. We've had $40 billion worth of high yield issuance so far. A year ago, that was $140 billion of high yield issuance. If you look at the equity capital markets, we're down about 75% in terms of issuance year on year. The constructive side of the equation is for the value side, for energy and materials, even getting a little help from ESG funds this time around, things that touch materials, things that touch energy. You know, you mentioned Cool Company, you know, MPC had a stake raise last week. So there is some activity for shipping, but let's not kid ourselves. This is a really tough start to the year. And if this turns out to be a high volatility year, the way 2018 was after 2017, you know, we won't get $850 billion of capital markets activity this year. But if we get back to 2018, at least we raised $340 billion that year. So the window will be open a few times this year, and companies just need to be ready.
Okay, maybe we can move to Chris Weyers from Stifel. Maybe you could, same question. Chris, you're muted.
Thank you, Rob. I was just saying my answer is quite similar to Jim's. I mean, 2021 was a record year, kind of across the board, despite it being a record year, kind of across the board for investment banking. You know, activity in kind of shipping and energy services, which is where I spend most of my time, in the U.S. market was definitely still down dramatically relative to what we had, you know, historically seen in prior years. If we look at kind of what's happened so far since Thanksgiving, as Jim kind of mentioned as the cutoff, you've seen kind of a huge fall off in growth stocks in particular. You know, like the SPAC market's now completely closed. Most of these SPACs have, you know, completely underperformed. You see in the news, you know, projections that SPACs, you know, put forward last year, you know, these companies aren't coming anywhere close to hitting them. So the, you know, the higher your growth story is as a driver of value, I'd say the worse your shares have performed. And then if you look at shipping and energy, I don't have the specific stats in front of me, but you know, those sectors are up dramatically since, you know, Thanksgiving. I would bet, you know, a lot of energy companies have seen their share price more than double. You know, a lot of shipping companies, I think on average are up, you know, substantial percentage points, you know, across really all asset classes. And asset values are way up in shipping. So, you know, even in the tanker space where, you know, the rates are still low, the, you know, owners will tell you their asset values are higher now than they were, you know, at this time last year or even at Thanksgiving of last year. So all things kind of material related have been moving higher. And I still, with all that said, I still don't see like a huge boom in capital markets activity coming like next week or the week after. but the markets are open to these companies that want to raise capital. It's just most shipping companies are choosing, not to raise equity capital at this point, given where their share prices are trading, and most have, huge inflows of cash flow because rates are quite good. So they don't really need to raise capital right now. But the markets are open. If you ask our analyst Ben Nolan, who I speak to every week, he's never had more calls coming in from institutions to talk about shipping names. So LNG is clearly like the most popular sector to discuss right now. But tankers and dry bulk and containers all continue to be popular, and the level of interest is at least 2 or 3 times higher than it was at this period of time last year. So I think it's just a matter of time before share prices get into a position where the better capitalized companies will look to opportunistically raise shares to grow.
Thanks, Chris. Larry, I suppose the same question for you, and I think you probably have your thumb on the SPAC market to the greatest degree out of the panelists here. Maybe you could also comment on what's happening in the SPAC markets alongside the shipping markets.
Yeah, happy to do that. I'm actually sitting on or hosting a panel in about 2 hours on the SPAC IPO market shortly here at our own conference today. But listen, I share the same views that James and Chris have as it relates to the market. Clearly, last year, best year, from a capital markets point of view, and some maritime companies and some energy companies, capitalized that in the market. I think the greatest theme that I could portray to kind of issuers that are coming to the market, you need to be ready and you need to move very quickly if you want to tap the capital markets, because we are in a very volatile market today. And those that are prepared and those that are ready are the ones that are going to be able to execute and get out pretty quickly. If you look back at last year in Q1, we did 6 or 7 transactions within the dry bulk space, raised a couple $100 million. I think we were pretty much the only active firm from an equity point of view in Q1 last year. Q1 of this year, we've done 3 transactions year to date, both from 2 companies that spun out from other listed public companies. Both of those deals, I would say, as the initial transactions that we got off were in the 3rd-ish type of week of January, where basically right when the war was starting in the market, it sold down 5 to 6, 7% in 1 week, and very difficult times to come out and raise capital. Now, one of those companies we recently priced, where we went from a $10 to $12 million deal to pricing a $69 million follow-on, where the company traded up, 3 to 4 times X of where we had originally did the transaction, and it traded with probably over $2 billion in liquidity over a 3 to 4 day period. So what's driving, especially in the maritime place today, is one, I do agree with Chris, well-capitalized companies will be able to tap the markets, but those companies that have more liquidity in their underlying names are the ones that are going to be able to tap capital and get larger size transactions done in the market. But I think from everything that's happening from a global macro point of view, what's happening in the commodity space, pretty much, the 4 or 5 major verticals within the shipping space are going to have opportunities to capitalize on that. And I think in particular, one of the names that we recently took out, they were kind of pair trading to where oil was. So it was a tanker company that got the benefit of kind of trading very similar to the upticks in oil pricing, and they got the benefit of being ready in the market and moving quickly, and they effectively tapped the market in a very short order to come out. Now, on the SPAC side, 12 months, what a difference the world makes as it relates to, one, the IPO market, and then secondary to that is the PIPE market and the amount of redemptions coming into numbers. So the IPO market, we've seen, last year there was about 250 to 300 transactions to get out in Q1. This year, you've probably seen about 50 to 60 deals get out. Typically last year in Q1, you were seeing very large pipes getting done in connection with transactions, which effectively were telling companies that were going to merge with SPACs that there was going to be cash there at closing. And that's been one of the big knocks on SPAC historically, is with in different times you might see high redemptions. But at that time last year in Q1, there was also a huge amount of dollars also staying in trust as it relates to transactions. Today in this market, the pipe market is virtually seized up. So there's not a lot of clarity to issuers that are looking to go public through SPACs if they're going to have cash or a closing. And you're seeing 88 to 90% redemption rates in most of the SPACs that are closing today. So I think that's a little bit of a function too of what's happening broader in the capital markets. The IPO market is not an extremely healthy IPO market. And I think typically, last year when it was a very healthy IPO market, SPACs were performing very well as well.
Well, I see Christa has just joined us. Welcome. Christa, just for your benefit, we're just speaking about what we're seeing today in early 2022 in terms of capital markets activity and where we think the opportunities lie for the shipping industry. And Larry was speaking a little bit about his experience with the SPAC market and what's happening there. Perhaps you can give your point of view on what's happening here in the capital markets right now.
Sure. And I apologize that I'm late, but I know that everyone else on this panel has plenty of good things to say. So
listen, you didn't hear me talk you up. I told everyone on this presentation that you're the co-chair of this entire conference, as well as being a moderator and panelist. So we all do appreciate the hard work that you've been doing. And
very good, very good.
And we're happy that you were able to join us.
So what do we see in terms of the market backdrop? It's been an interesting first quarter of 2022, that's for sure. Most of the shipping segments are trading up year to date. Container sector continues to do fantastic. The dry bulk sector is kind of up anywhere from 20 to 40%. Tankers are up a little bit. But the broader markets have been challenged with everything happening geopolitically. We started out in January and saw, the S&P was down maybe 10 to 15%, but growth-oriented sectors were down more than double that. So before we had the Russia-Ukraine situation happen, we had an environment where investors were risk off in terms of growth sectors. Overall market saw some pressure, interest rates were rising, and there were just some general concerns about the backdrop. And then, Russia-Ukraine happened, markets traded down further. If you look year to date at where we are, the S&P is now up modestly, and the only sector of the S&P that is traded up year to date is the energy sector, of which, many shipping stocks could kind of also be categorized, whether you think about LNG or tankers. So it's a volatile backdrop. It's one where, we haven't seen a lot of shipping companies come to the markets to date for various reasons. I think balance sheets are healthier. Many companies in different sectors have a lot of liquidity. But I will say, there's certainly evidence to suggest that investors should be excited about coming into this sector in today's environment, and every segment has different dynamics, of course. So we think companies will have access, but it's certainly a volatile backdrop. And it's been one, overall, 2021 was a record year in terms of overall equity issuance. That has dropped off dramatically in 2022, given everything I just talked about. But in any case, you're always better off as a company when you don't have to raise equity and you can do so opportunistically.
Thank you, Christa. Let me just turn back to Jim a bit here and drill down a little on the IPO market. What are you seeing at DNB in terms of prospects for IPOs? And is there a sector-specific, attraction among investors for new issues, or is it more of a diversification play in terms of investor appetite?
I would say it's certainly a sector-specific appetite. About a month ago, we raised $900 million for VAR Energy, which was a Norwegian E&P IPO. If you did anything that touched any energy or materials in the first quarter of this year, you probably got it done. And there are very few other sectors where that was possible. And I mentioned before that even the ESG funds have been helpful. You know, the true ESG funds had a really tough year last year, but they've actually been very, very useful for shipping. We were able to get 3 sustainability-linked bond deals done last year for shipping companies. The ESG funds in the U.S., the number 1 sector they purchased in January was materials. The number 3 sector they purchased was energy. So everything that touches energy materials, so everything from dry bulk to containers to LNG, all those things have worked. You know, granted, we did this transaction last week in MPC, and we did the transaction in Pool Company about a month and a half ago. There is a pipeline to do more. There is some IPO pipeline out there as well. I do think, like in 2018, there'll be some windows this year to get things done. And I also think you're going to see some of the overhang in terms of some of these stakes that are held by associated companies or private equity. I think you'll see some of those stakes come for sale this year as well. The flip side is, in terms of secondary business, the ATM program has been very successful in the last year. We've been very active with a tanker company in the first quarter of this year. It's the kind of thing where you put a filing out there and you sell the stock, you know, when and if you want to. Even though markets have traded in a volatile way, volumes have been pretty good. But getting back to your original question, as far as IPOs, yes, we have a little bit of backlog of business to get done, and fingers crossed that we have a window to get some of it done before summer gets here.
And just turn to Chris. Chris, what do you see as the challenges in the IPO market for shipping companies?
You know, it's a good question. What's challenging, you know, changes like everything else in the capital markets. But historically, what's been challenging is the public comparables, you know, trade at, you know, very low valuations. So, you know, anybody that wants to go public, you know, if they talk to any investment banker, they'll tell them you need to look at where your public comps trade, and you're going to take a discount, you know, to, you know, where the public comps trade. And that's, you know, kind of the value that we'd be able to list your company at. And when public comps are trading at, you know, meaningful discounts to net asset value, there's not really appetite, you know, of private owners or private equity funds that own fleets to try to list shares at that valuation. Now, if we fast forward to right now, you know, there's certainly some sectors where, you know, I think valuations have approached or even maybe exceeded asset value. So dry bulk certainly trading close, maybe a little bit above asset value at this point. The tankers and containers as a whole are trading, you know, dramatically below. There's some other sectors where you don't really look at asset value. That's really in the LNG space, whether it's, you know, traditional LNG shipping that's on long-term charters, or FSRUs, or LNG liquefaction facilities. You know, I think the valuations in that sector are at the point now where it certainly makes sense for companies to list. There's one public company that I'm aware of that's publicly on file, you know, Accelerate, you know, which is, you know, I think it's the largest or the second largest owner operator of FSRUs. And, I think it's an ideal time for a company like that to try to go public. You know, we all see the demand in Europe, you know, to get U.S. Middle Eastern gas, you know, over Russian pipeline gas. So, for that sector, I think we'll certainly see some issuance this year.
That certainly makes a lot of sense. Let me turn to Christa, back to Christa for just a second. So a little more than a week ago, as you may know, the SEC proposed some new disclosure rules that will require enhanced risk factor disclosure and other more enhanced disclosures about climate change. And, our industry has really been at the forefront of decarbonization and climate change for quite a while, given, the shipping regulatory scheme. Oh, can you hear me? Okay, so given the regulatory scheme, how do you see this playing out, and how will it affect the public shipping companies' perception in the capital markets? Do you think that this enhanced type of disclosure will help us, or will it, tend to highlight some of the more sensitive areas in shipping, and maybe the more, more uncertainty that exists in the path that we will be taking toward decarbonization?
So I'll just give a view. I don't know that a change in SEC disclosure requirements really changes the public perception of this topic, because there certainly already is a huge spotlight on the topic with public markets. And lots of questions out there, lots of companies kind of proactively talking about these things already. And you've had different sources trying to rank companies and so forth. So look, I think the disclosure element of this is important and it's critical. But independent of that, investors are demanding answers anyway in terms of how companies are navigating through the transition.
Yeah, Larry, that's an interesting point. I mean, what are you seeing in your shop, as well as with ESG funds? This relates directly, I think, to the ESG funds and investing in general. So will the shipping industry be green enough for ESG funds? In the short and long term.
It's TBD. I think the reality is, I think the general disclosure is good. I think, some of the dynamics that are coming into the market, I think, are better for companies as a whole. But ultimately, at the end of the day, is because you kind of pretty up the pig to a certain extent and put all these things in place, investors still look at fundamentals of the business, right? And ultimately, if a company is overvalued or if a management team is not performing, those are going to be the biggest drivers for driving dollars into a company and getting the right type of investors. So I think ultimately, very good things for the broader markets. I think the diversity dynamic is incredible for companies. As a husband to a wife of a CEO of a company, and what women go through in their business on a day-to-day basis, these policies are critical, and I think dramatically going to change how we do business going forward. But I'm still of the view is, good sound businesses that are heeding to the right disclosures are still the ones that are going to drive to the right type of investors coming into the business in the long run.
And Chris, I thought did you have a comment, Chris?
I know the questions come up, a lot on ESG, and I think I've said this at a previous Capital Link conference, but 18 months ago, I didn't really hear U.S. investors talk about ESG at all. Now it's like overwhelmingly talked about, on all our deals. I can't really speak to what like Fidelity and Wellington specifically say about it as it relates to, kind of passive investors in public stocks. But, in the M&A transactions we're working on, which is, where I've been spending most of my time, the last year, the private equity firms and the hedge funds that do direct investing into businesses, ESG has become a huge focus, and it's a huge focus of all of their LPs. So the number of funds that'll invest in tanker shipping, for example, is always relatively small, but it's dramatically smaller now than it was 18 months ago. And the number of people who will invest in like upstream oil and gas, which I know is not what we're talking about, but certainly, a related industry, is, probably down by at least 75, 80% relative to what it was 18 months ago, just simply because, these investors, are, they only want to do deals that are going to appeal to all of their LPs. And there are certain LPs that just, are staying away from any non-ESG friendly investments. So these funds are staying away.
Thanks, Chris. Let's just shift a little to debt capital markets, and we'll just get back to Jim a bit. The Fed here in the U.S. did announce, I think pretty poignantly, that they will be tightening credit. It's already started to have an effect. Inflation seems to be, or at least the expectation is that inflation will persist for a bit, and that it may persist at around the 8% level. In this environment, what is happening in the debt capital markets for the shipping companies, and can deals get done, or are we kind of stuck in a balance sheet improvement phase? I mean, we had heard at the owners panel that there's a lot of both share buybacks in focus as well as deleveraging. So how are we doing in the debt capital market at this stage?
So can deals get done? Yes, they can, but sticker shock. So let's just roll the clocks back 6 months. Let's go to September. And let's just look at the 10-year curve. And so we're up a little over 100 basis points on US 10 years. If you look at the triple B curve, we've widened by 200 basis points since September. So if you're effectively a triple B company, if you were looking at the market where you could potentially issue paper at 6 or 7% in September, you're now looking at 9 or 10% now. What makes it a little bit tougher is you think about, for us, all these Norwegian bonds that we brought to the market last year, whether they were straight bonds or whether they were sustainability linked bonds. And you had a differential between the high yield bond market in the US and sort of the shipping bonds we were bringing in Norway last year. You had a differential of about 200 basis points. So if you're a US mutual fund and the differential is that wide, you're spending a lot more time looking at Norwegian bonds. After the developments in the market in the last 6 months, that differential is gone. We had deals last year where half of our demand from a Norwegian bond came out of the US. I think we've done one shipping related transaction so far this year, and the demand from the US was nowhere near that. I don't even think it was 25% of the demand. So yes, it's more difficult to get done. Bond deals are doable, but you're 300 basis points worse off than you were 6 months ago.
Christa, do you have any view on that over at Citi?
Yeah, no, definitely. I mean, look, spreads have widened. That's the markets that we are in. I think you have to be careful when you compare the Norwegian and the US markets because there's a tenor difference. Usually when you look at Norwegian bonds, they're shorter tenors than the maturity dates of US bonds. So you just have to be careful you're comparing apples for apples there. And I think last year, I mean, Citi's not, you're not seeing us lead deals in the Norwegian bond markets, but last year we did have some success with various companies in the shipping sector with inaugural issuances in the US markets. And, but Jim's absolutely right in terms of where the markets are today. So I go back to the same point I made on the equity side. From an issuer's perspective, you're always in a better spot when you're not forced to come to the market for anything. And right now we are certainly in markets on the debt side where if there's not a need to go do something, you're not seeing issuers come.
Okay, I know, Larry, your shop, you tend to focus more on the IPO and SPAC markets. Are you seeing any activity in debt, or are your customers really focusing on those equity markets?
Yeah, listen, I would say is the vast majority of our business is more equity, focused. I would tell you is across many of the sectors that we're working in is, converts are very much thematically out there. We're having a lot of inbound calls for companies, especially within the shipping space, as liquidity and volatility is picking up. So I think we're actively, looking at a couple transactions right now. But that's, the same in a lot of other sectors that we're focusing on. So, some stock prices have sold down, and as a function of, some higher, let's call it, conversion prices, we have a number of issuers that are also looking at it where they still feel relatively comfortable from an equity price point of view, but, clearly with the ability to sell up at a higher level, and pricing potentially still being relatively good. I think there's some active interest on that front.
Yeah, let me go over to Chris on that just to expand a little bit. It would seem to me that with rising interest rates, investors may not have to chase yield all so much in these kind of investments because they might be able to get yield elsewhere. What are you thinking over at Stifel on that? Are we going to see more debt activity maybe a little bit later, or is it really going to be really an equity story and perhaps maybe more of an appetite for growth rather than yield?
I think if you talk about the retail investors, really focused, I'd say, more on equities right now. They'll do fixed income investments, but they need to have rate resets. Like no retail investor wants to lock into, 10-year fix, or these preferreds that, we do some of the time. Every once in a while, those deals are fixed for life. Everybody, is comfortable moving forward as long as things will flow. But you've got a short-term issue right now that you've got the Fed funds rate is at like 25 pips the last that I looked, and inflation's at I think you said around 8%. So there's a huge discrepancy between short-term rates and inflation. So, the short-term rates have to catch up to inflation, or inflation has to come down to the short-term rate. Something has to come to bridge that gap, I think, to get the fixed income markets, functioning better.
And we did hear a little bit at the end of 2021 about the Greek high yield market opening up a bit. There were a handful of deals that were done over there. Are any of you hearing anything about activity in the Greek high yield market as opposed to the Norwegian and US markets? Yeah, I guess not too much. Okay. So maybe we can just end our panel because we only have a few moments left with just a few thoughts from each of you. Short thoughts. Jim, why don't we start with you and we'll go around the horn.
Once again, I think we're in for a year like 2018. And there will be windows and there will be opportunity to get deals done. Getting back to the bond market for a second, bonds mature. You got to do something about them.
Hey,
and
Christa.
so there will be activity.
Go ahead. Christa, would you like to share some thoughts quickly?
Yeah, sure, absolutely. Look, I think access to capital is always a strategic advantage for any company, and in particular in shipping sectors. It's been a volatile year so far. We expect more. Agree with Jim, there will be windows. And so, but I think a lot of the public companies today are doing the right things in terms of how they're managing their businesses and managing their balance sheets. So, so my hope is that, the capital markets will continue to be supportive for companies who use them to be growing their businesses. And so I think it will be an exciting future for the sector.
Chris?
Yeah, so I think we're in a high volatility environment, so it's hard to say kind of what this year's going to look like. But there's a lot of liquidity out there. I think people have a lot of capital they want to invest, but I feel like things are headed more up than down, and the markets are open. But we need a little less volatility for people to be more opportunistic.
And we'll just end up with Larry. Larry, you get the last couple of short words here.
Yeah, listen, I think the theme here is volatility, volatility, volatility. We're all seeing it. You're hearing it from all of us. I think as an issuer, If you're looking to get into the markets, you can't catch up to it. You have to put your head down and drive to want to do a process. And I think there will be opportunities to transact.
I thank each of you for doing a wonderful job here this afternoon, and I turn it back to Nicholas, who's arrived
Well,
on
my
this.
job is very easy. All I have to do is say thank you to all of you for a great discussion. So thank you very, very much. It's been indeed very informative and terrific content. Thank you.
Thank you.
Thanks, Nicholas.
Thank you, everyone.
Thank you.